In this lesson, we'll briefly discuss how the accounting profession requires companies to report accounting changes. Let's discuss, first of all, a change in accounting principle. This refers to a change from one acceptable accounting method to another, such as a change in the inventory method from LIFO to FIFO. The key here is it's counted for retrospectively by revising our prior year financial statement, which involves lots of work to redo those financial statements. There are 3 steps required for this approach. I've got to revise all my comparative financial statements. 2, I have to adjust all the affected accounts for the change. And 3, and probably most importantly, I've got to put this in my disclosure notes for my readers because GAAP basically requires us to explain why the change was needed. In other words, you must justify it. You have to highlight the revised information. And thirdly, report any of the impact on your earnings per share. Please note that a change in depreciation, amortization, or depletion method is accounted for prospectively, which is the same as a change in estimate, which we're about to explain next. So now let's discuss a change in estimate. These are very common, by the way. This is a change due to a revision of an estimate due to new information or new experiences for the company. Examples would include bad debt expense, which is your percent that's deemed uncollectible, warranty expense, where you change the percent of products for which there might be a warranty claim in the future, and thirdly, depreciation. This could be a change in salvage value, useful life, or the actual method of recording depreciation expense. The key here, though, is that it's accounted for prospectively, going forward only, and requires a disclosure note. Since these change in estimates are so common in today's world, I'm going to move over to the whiteboard now to illustrate how we would calculate a typical example. We just talked about change in estimates, and these are very common. They occur quite a bit. So I want to go through a practical example of how this would work in a change in estimate where we have an asset that cost $63 million back on January 1st of 2014, has a 5-year life, and has a $3 million salvage value. So in other words, we've got to depreciate the difference of $60 million over the 5 years. We're going to switch our estimate of this depreciation from sum of the years digits to straight line. Here's the first 2 years that we see under the sum of years digits. It's an accelerated method, as we've talked about. So basically 36 million of the 63 million gets expensed in those first 2 years. I have a book value at the end of 2 years of $27 million. If I then reduce it by the salvage value of 3, I basically have $24 million of value left to depreciate over the remaining 3 years. But now switch it to a straight line method. So I would simply take my $24 million, divide it by the 3 years that are left of its useful life. In essence, my depreciation would be the $8 million per year for each of the remaining 3 years. Keep in mind a key concept. This is a prospective adjustment, which means we change it going forward only. So I keep the depreciation for the first 2 years under the old method and then change it to the second method for the next 3 years. And that gets us to the $8 million a year. And that, my friends, is a change in estimate in accounting. Hopefully that whiteboard example made more sense out of the change in accounting estimate concept. Next type of accounting change is a change in reporting entity, which quite honestly doesn't happen that often, so we're not going to talk too heavily about that one. And lastly, we discuss error corrections, which are treated based on the timing of the discovery of the error. For example, if the error is discovered in the same year, which is ideal by the way, then our incorrect entry is simply reversed and a proper entry recorded. But if a material error is discovered in a subsequent year, which requires then a prior period adjustment, this involves lots of work for our accounting staff. It basically requires a corrective entry to adjust any of the balance sheet accounts, while any income effects are adjusted in that beginning retained earnings balance.